Moving on now, we do have a lot of companies which are on our radar on the back of earnings that they've reported. In fact, MPS reported a soft quarter for Q2 with a mild surge in revenue and profits. Company's overall margins saw a slight dip, but platform margins jumped to almost 50% from 35%. Rahul Arora, who is the chairman and CEO at MPS, is joining us now to decode the earnings and talk about the outlook going forward as well. Rahul, good afternoon. Thank you so much for joining us. Well, can you give us a sense of what led to the soft top line this quarter? You have said historically that Q1 has been the softest, while Q3 and Q4 are the strongest. But this time, Q2 actually has been softer than Q1. What really happened here?
Yeah, so usually, growing, again, firstly, thank you for having us. Growing pains as a business, typically we have one soft quarter a year. On average, over the last decade, it's been Q2. Last year, for some reason, it was Q1, and that's why you're seeing this year-on-year effect. And a large reason for that is, most of our customers are based in the Western markets, and therefore, summer tends to be slow. In the same breath, Q3 then ends up being disproportionately more significant. So, we're not losing any sleep over it. In fact, if anything, we are optimistic that the platform business has done extremely well. That's one part of our business that sees very little seasonality. And as the company grows and, revenue gets more diversified across markets, the seasonality will obviously have also less choppiness. We're expecting a robust second half of the year, and also have reported or rather guided our sense of what the second half looks like.
Rahul, I wanted to get some color on the second half of the year, but just for the benefit of our viewers, first to lay out the company's 2028 goal plan. The company's revenues are a little more than 500 crore rupees. I think 520, 530 crore rupees as things currently stand. You want to scale it up to 1,500 crore rupees by FY28. Of that, you have said 900 crores will come in organically, which means revenues go from the current 500 crores to 900 crores by FY28, and the balance will be done via acquisitions. Now, to get to that 900 crore revenue by FY28, you need to do organic revenues of about 12 to 13% every year. Are you on track to do it this year? Because so far in the first half, it's been about 8.5%.
Yes, so again, like I said, the second half is looking stronger. So absolutely on track to hit, the organic growth hurdles for this year. In fact, while the aspiration is to get to 1,500 crores by FY28, much of that is going to be front-ended. So we are hoping that FY25 and FY26 are at a higher growth rate than the average. But yes, absolutely on track to hit, the growth rates that we've projected. We're seeing significant growth in our platform business in Q4, and relatively good growth in our content business and e-learning business in Q3 itself. So, feeling very confident and, happy to report that we're on track.
Okay, get that point. So the growth that you're talking about, you will be able to achieve it at profits of around 130 crores in FY24. What margins will it come at? In Q2, you've done 31.3%. What's the outlook for FY24?
Yeah, I think whenever our revenue grows by 10%, we tend to see some margin expansion, and we expect that to continue, into FY24. So, last year, around the same time, we had given a PAT guidance of 109 crores when the previous years, much higher than the previous year. And this year, I think our guidance is north of 130 crores on PAT. Typically we tend to be very conservative on our guidance. So whatever we're stating is, we feel that we will comfortably achieve. So, as revenue grows, margins will continue to expand. On average, we've seen, as long as revenue grows at 10%, margins do expand fairly significantly.
So what could FY24 margins stand at, Rahul?
Sorry, I missed that.
What could FY24 margins look like? You said that they should expand. So what's the quantum of expansion that we're looking at?
Yeah, I think last year we did about 31%. So this year, possibly 33, 34%.
Okay. So you also spoke about how your platform business is doing well. That's where margins increased to 50% versus 35%. What's driving this growth, and is this something that is sustainable?
Yes, I think so. This is, for everyone's knowledge, this is a successful turnaround of an acquisition that we did back in 2020. And we have significantly changed the operating model of that business where engineering and delivery is being led from India. And in any product business, typically when your revenue is flat, you're investing to improve the product, so to create some sustainable level of growth. We've done exactly that over the last couple of years. So this is not something that's magically happened in one quarter. It's been a sustained effort over the last 2-3 years. And essentially what we're seeing is, all those investments that we've made are now converting into revenue from existing customers moving on onto newer product technology, but also addition of new customers as well. And as a result, since your marginal costs when you onboard a new customers are fairly insignificant compared to the revenue increase, there is a margin expansion that takes place. So we expect the platform business to continue with the current level of margins,
which is about 50%. Rahul, thank you very much for joining in. That's MPS Limited for you, previously known as Macmillan Publishers. They get they have 3 sources of revenues. One is content creation, that's 50% of their revenues, and the balance 25% each comes in from e-learning and platform for them is now the fastest growing segment. We will get into a break on that note. We'll come back and invite HP Singh from Satin Credit Care on the show.